I'd just like to start by welcoming you all as well. I'm Kevin McNulty, I work for ISLA, and this is the 5th conference that I've been involved with whilst working for ISLA, so I'm very pleased to be back in Berlin. We were here 4 years ago, and I'm sure some of you, many of you may well have been here then. Last year we were in Prague, and the feedback we got from our delegates last year was that it was a great conference, but the weather, 37 degrees and searing sun, was just a bit too much. So we were told, could we make it 21 degrees and partially cloudy? So I think we've done quite well so far on that front so far this year. Anyway, what we want to do today, thanks Andy, is to give you a little update on a bit about ISLA. We want to talk a little bit about the marketplace itself and share with you some very high-level statistics on the securities lending market, and then talk about some initiatives that are impacting the securities lending marketplace, including the things that we're currently working on. So we can skip to the next slide. So I just wanted to explain to you just a bit about ISLA first. I won't take very long on this, but some of you will know that ISLA is an association that represents the securities lending marketplace. We are structured in a way where we have a board of directors that are drawn from our 90-member firms, and that board of directors essentially sets our priorities and our objectives for the year. And we've just listed the names up there, the current board chaired by Andy Krangle from Citibank, who's somewhere out there. We've been very keen to ensure that the board of ISLA is representative of our broader membership. And we're pleased, I think, this year to have, I think, the most representative board that we've yet to have. And that board includes both borrowers and lenders of securities. It includes buy-side and sell-side firms. It involves business units that cover prime brokerage, agency securities lending, treasury functions, and for the first time ever, a proper beneficial owner. So we've got nice broad representation of the industry there. We also have good geographic representation from across Europe, with board members based not only in the UK, but in France, Germany, Netherlands, and Switzerland. And this year we've really worked hard with our board members outside of the UK to put on some very successful roundtables with market participants in Paris, Geneva, Frankfurt, and Amsterdam. And we've reached out much more to local regulators to ensure that they understand more and more about this marketplace. So I think a good start. But the real work, Andy, if you could move us on, thank you. The real work at ISLA gets done by bringing our members together through working groups. And we have 4 standing working groups that meet fairly regularly. And these are the legal and regulatory, the tax working group, which John chairs, corporate governance and operations, and that breaks down a little further. But from time to time, as we have issues to deal with, we set up special working groups, and 3 of those are listed there, which are very live at the moment. One is looking at the implementation of Basel III and what it means for this industry. Another one looking at the new regulation on transparency for securities finance transactions, which Ed referenced. And a third one that's looking at the ongoing development of UCITS regulation. And those of you that manage or look after UCITS funds will know that there's quite a lot going on with UCITS funds right now, affecting their ability to engage in securities financing. So what I wanted to just ask you before I leave this little section on ISLA is that for those of you that are members of ISLA that would like to get involved in these working group discussions and help us formulate our positions and policies on these things, we very much welcome your involvement. And for those of you that may not yet be ISLA members, if you're interested in joining ISLA and want to understand a bit about what the benefits to your firms might be, please talk to us about that too. Well, we wanted to share with you a little bit about the conference as well. Ed's already mentioned a few themes, but at this stage I'd like to hand over to my colleague Andy Dyson to share perhaps a few thoughts on what we see in the agenda this time.
Yeah, thanks Kevin. Good afternoon everyone. For those of you who don't know me, my name's Andy Dyson. I'm the Chief Operating Officer of ISLA. Been with the group now just about 18 months. I don't want to sort of necessarily cover some of the ground that Ed went over, but just quickly looking at the round tables, I think one of the things just to bear in mind is that I think in previous conferences, the round tables fed from the main conference, and they tended to be positioned, as Ed alluded to, at some point during the 2 days. I think what we want to do with the roundtables, and it's great that so many of you have committed to join one of the sessions straight after this particular session, we want those roundtable sessions to feed into the main conference, and each of the moderators and co-chairs of those sessions are pretty much on the hook to bring those issues forward into the main conference. So we think that this is a great opportunity to talk a little bit about some of the, the more thorny issues that we face in our market, particularly around Basel III, but also, as Ed mentioned, where there are opportunities to make some money. So I think, please, if you can get time, join those sessions, because I think they're going to be both interactive and quite interesting. The other thing that's changed a little bit this year, and thanks to Ed and Mark for looking at the world and from a slightly different perspective, is you'll see from the agenda that we've got pairs of debates. So we've got a demand debate which comprises of two broad panels, one looking at it from the hedge fund perspective and one looking at it from the bank perspective. The one thing I'd say there is that what we've done throughout that session and some of the other sessions is you'll see some moderators that you perhaps won't have seen before, both from outside the industry or even moderating some of our panels. That's very much a conscious decision by the group to try and get a slightly different perspective on the world, because I'm sure you appreciate that some of these panels, these are topics that we've talked about many times in the past, but we feel that by looking at them in a slightly different perspective, there's more to be had, particularly as the market begins to change, often obviously a lot driven by regulation. And then the cash debate is a similar sort of perspective where we've got two sides of the same coin. And I've written in my notes here that actually this couldn't be more topical. We've seen what the ECB's done in the last week to 10 days regarding interest rates. We've been sort of, not quite inundated, but we've had a trail of inquiries from members about what to do in a negative interest rate environment, which is an interesting place to be for many of us. Some of us that have been in this market quite a long time will have seen similar instances, but we are now in a situation, in some cases, where we're moving into uncharted territory. So I think this will be a very interesting debate, and you could actually say that chasing positive returns might be nothing more than chasing the minimum negative return that you can get from your particular investment. So I think it's a very, very topical debate. We're looking forward to quite a different perspective on the way liquidity moves around the markets. Kevin?
Yeah, thanks, Andy. I'm not going to talk too much about this one because Ed already lined it up, but I don't know if you're like me, but every day I see a new white paper on collateral or a new conference cropping up on collateral. It does seem to be the subject of the day. I think what we're looking for today from or on Thursday from our conference is to really hear from market practitioners what's really going on and what do they really think is going to happen in this space of collateral and the new developments. So kind of very much looking forward to that. Andy, if we just press on. And Ed mentioned that we closed the conference with a perspective from beneficial owners. And as Andy mentioned, we've reached out this year to make sure that we get perspectives from not just within our marketplace, but from those from outside of it as well. And on that last panel on Thursday, we will have Nicholas Fursley, who's the Director General of the World Pensions Council, as well as Rudolf Siebel, who's the Managing Director at the BVI, that's the German Asset Management Association, giving their perspectives on securities finance. And what we're going to be asking them is, where does this fit within the strategic objectives of your members and the firms that you care about? I think that's going to be a very interesting way to wrap up the conference. Okay. For those of you familiar with my history, this will be a chart that I've probably sat in front of many of you talking through in the past. This is a very brief synopsis of the shape of the market that most of us deal in on a day-to-day basis. The reason it's there is just to provide a tiny bit of perspective for any of you that perhaps new to the market or coming back to it from some time away. We've got a market that provides securities for lending activities that is estimated to be something around 11-12 trillion of securities available at any one time for lending. That's in euros. And as the next slide confirms, sort of somewhere between 1 and 2 trillion on loan at any one time. I think that one of the most interesting elements to this, though, and we find this when we talk to regulators and policymakers all the time, is the constitution who actually owns those securities that are deployed in the market, often on their behalf by agents. And I think that one of the things that we have successfully sort of moved ahead on during the past 12 months is actually
if you like, looking and working with regulators so they better understand the dynamics of this market, not only where the securities come from, but also the fundamental need to borrow securities and why this market is actually important in the context of maintaining, you know, a fairly stable and transparent capital market. So I think we've done some good work that Kevin alluded to, particularly in some of the regions. We've done forums in Paris and Amsterdam, with more planned across Europe in the coming weeks and months. The next chart I just wanted to leave you with is very much a chart that shows perhaps a growing confidence in securities financing, with more securities being made available at any one time for lending. We can see from the bottom line that the inevitability of some of the challenges we all face that we'll discuss over the next couple of days, that demand line really hasn't moved much in the last 5-6 years. The question is that demand line going to change, particularly around things like collateral upgrade trades, what's going to happen with fixed income, what is actually going to happen with dividend arbitrage trading, and will things like the FTT have any long-term impact on what we do, particularly around utilisation. I think that the next sort of line that leads us to is a quick sort of run through of some of the high level, more important topics that we've been working on at ISLA in the last 12 months. Any of you who've been on the various conference calls and meetings that we've had on Basel III, hopefully will see that we've actually made some quite significant progress with regard to Basel III. This is one of those regulations that's been there for quite some time. So there's nothing new here. It's just a question of how we deal with it, how we as an industry navigate our way through. Inevitably, one of the things that's brought to the fore is how we deal with agent lender disclosure in Europe. I think it's fair to say that the jury's out in terms of does agent lender disclosure work or not. And I think depending on your perspective, there's certainly some work to do to bring agent lender disclosure up to something that we would all feel is, from an ongoing perspective, fit for purpose. Having said that, I think that what the Basel III discussions have allowed us to do is revisit ALD. It's also, for the first time in several months, if not years, brought the idea of a CCP for our market back into focus. We've done some work with a number of the providers, and we did a presentation recently where we looked in detail with one of them regarding the capital costs and the potential advantages of using a CCP. My sense is that the use of a CCP in our market, that will be discussed over the next couple of days, is getting closer. And I think it'll be one of the alternative routes to market that those with securities may choose to deploy over the coming weeks and months. The other thing which I think that Basel III has brought a new rigour into our world is simply the way that we look at the various counterparties that face off to our broker community, in particular the ability to net positions. I think we've all faced some challenges in terms of interpreting the various opinions that we see from different jurisdictions. Tina, who unfortunately can't be with us over the next few days, has done some great work in the last 12 months in revisiting a lot of the netting opinions in jurisdictions. And I thank all of you for your interaction in that space, because we're now moving forward to get a better perspective on which counterparties and jurisdictions actually work from a capital and netting perspective. And the final thing I'd say about Basel III is that's also allowed us to think a little bit about what the future state of this market might look like. And in particular, the role of CCP came up through that route, but also other areas around the use of match principal books and things like this, I think are increasingly part of the future debate that we've had in the past 6 to 12 months. So I think Basel III, although it's something which is a challenge, I think we have to accept that. It has forced us to look at our business in a slightly different way, and I think actually it's providing opportunities. Kevin.
Thanks, Andy. The second key regulatory topic that we're spending quite a lot of time on at ISLA now is the EU's proposed regulation for securities financing transactions, the SFTR as it's currently called. And this, unlike Basel III, which we've known about for some time, this is actually a new regulation. This is something we didn't know about last year. And when the Commission published it at the end of January, it took us all a bit by surprise, I have to say. But nonetheless, it's designed to implement the Financial Stability Board's principles for securities finance transactions as they relate to transparency. And what we see in this particular draft regulation is actually something that we think is designed to do that. It does a couple of other things as well, but it covers primarily the idea of disclosure of securities financing transactions. As you might expect, the Commission took the view that this type of transparency for securities financing transactions should be the same as it is for OTC derivatives. And so what we have is a model that's very much based on the EMIR regulation, which requires derivatives to be reported to trade repositories. And there's two other elements to this particular regulation as well. One is that there's a set of requirements that fund managers need to disclose to end investors in funds that engage in securities financing transactions. And there's some fairly detailed requirements in this regulation about what should be disclosed and when and how. And finally, there are some provisions in there about disclosures that need to be made before securities can be rehypothecated. So this is a fairly broad regulation, and as I said, we're spending quite a bit of time on it right now. This is one of the ones that we've set up a working group to look at, and we have a relatively advanced position paper already on the idea of reporting to trade repositories. So if anybody wants to see that, they should let us know. It's still work in progress, but I think we're comfortable sharing it on a draft basis. We're arguing that for securities lending transactions at least, it makes much more sense to report what we call positions rather than lots of individual transactions. And the paper spells out what that means. I think when we've discussed this a bit with the Commission, the concern is, yeah, but if you just report positions, what are we missing? What are we hiding? And we're trying to show them that actually if you get positions every day, you actually really see everything that you need to see. And from a regulator's perspective, policymaker's perspective, you get better information. So our position paper is designed to promote this idea of position-based reporting, which is outstanding loans essentially, and to explain why we think that that's the right way forward. There's quite a bit of work to do yet because there's complications, as there is in the world of derivatives reporting, with things like collateral. There are also complications, as there are in EMIR, about double reporting, i.e. both sides to a transaction have to report. That creates issues for policymakers in trying to understand where duplication exists and how to stop that duplication when you try to understand the bigger picture of the market. Now, in terms of the progress of this regulation, it's an interesting one because it was published by the Commission. The draft was published by the Commission in January. That was just a few months ahead of the European elections, and that meant that the European Parliament itself was unable to pick up this regulation and run with it. The European Parliament has to approve it, they have to agree it, they have to negotiate it. So the European Parliament essentially is doing other things right now. They're figuring out how they need to organise themselves within the various committees. So we don't think they're going to get to this regulation until the late summer. However, the other legislator in Europe, this is the European Council, has been starting to look at this. And there was a meeting of the European Council a couple of weeks ago where they started to consider some of the bigger picture issues. And our goal is to have a position which we can share with those policymakers as they're starting to change and make this regulation into a final regulation that will become effective. So on this particular one, I would leave you with no doubt that there will be a trade repository requirement for securities financing transactions in Europe. We're probably going to see what that looks like finally around the end of this year, and we expect there to be about a year for it to be implemented. So this is quite new, it's quite exciting. It is an area that if we want to influence it, we need to get our act together quite quickly and work together on it. We are working very closely with other trade associations wherever it makes sense, and in this regard we have very close ties to the European Repo Council of ICMA, and with regards to the fund manager disclosures, we're working very closely with IFAMA, who have a very strong interest in that particular subject. So watch this space, and as I said, we should be in a position to publish our position paper on the trade repository aspects of this quite soon. At this point, I think we're going to hand over to John, and we talked about the FTT, and John's going to give us an update on the FTT and some other tax issues.
Thanks. Apologies for this being sort of a recurring, boring subject with the UFTT, but I'll just give you a brief update on where we see things at present, and also really just to give some background to base erosion profit shifting, which is an initiative by the OECD, part of many actions that they're looking at to stop transferring taxable profits to low tax or no tax jurisdictions. Primarily the drivers behind this are Starbucks and Google, but there's many actions behind it. But as we see it at the minute, the paper on BEPS for hybrid mismatch includes stock lending and repo transactions, but I'll get to that very briefly in a second. Going to FTT, ECOFIN's statement in May this year wasn't sort of really anything to write home about, apart from the fact that they agreed, the 11 agreed between them that by the 1st of January 2016 there should be a tax on equities. But rather confusingly, they also said as well that if a member state chooses to implement an FTT on something else outside of equities after 1st of January 2016, they can go ahead and do that should they wish to. So if this were to come to fruition on that date, you could have, say, for example, Spain having an EU FTT on equities, but a unilateral FTT on debt securities, a unilateral FTT on derivatives. So there isn't any consistency around other instrument types, so they're just focusing on equities at 2016. Now, bearing in mind that they've been talking about this for the past 2 years, and they pontificated at the last working group meeting about, oh, how do we tax derivatives? They still haven't addressed, they being the 11 and the EU Commission really, still haven't addressed the fundamental problems with the draft directive as it stands at present, and that's to do with establishment and cascading. Establishment turns this tax, or the potential tax, into a global tax charge through deemed establishment and the counterparty principle. That problem hasn't gone away, and I think that we need to see that gone, and we need to see a one single tax charge on the buyer, similar to an SDRT or a French or Italian FTT. So those fundamental problems still haven't been dealt with, and the ambitious side of this is that by the end of this year, the 11 are meant to have some draft law together, ready to implement next year for starting on the 1st of January 2016 for equities. I think they're sort of not really on the right page there, but the problem around this is, I think, is that we can say that, or I can say that, but the political process behind this is very, very strong. And I guess the concern is that I certainly have is that something may come out and they just get it wrong and we have to go and fix it, or they have to go and fix it afterwards. But I think you can't forget the fact that EU FTT is out there and it is a threat at present to this industry with regard to cascading and establishment. Base erosion profit shifting. Number of actions out there. Action 2 is hybrid mismatch. Now, it's easy for me just to read from the OECD paper within the interest of time here. A hybrid financial instrument and transfers. The hybrid element of that is a difference in the tax treatment of the instrument means that payments under the instrument have a different character. Stock loan transactions, you can get that when you're passing manufactured payments, rebate fees, loan premium fees, fees for lending under the transfer of securities, collateral movements, manufactured payments with regard to collateral positions if they were to be held over record. When you look at those transactions or those payments cross-border, they do tend to have different characteristics. They're treated differently in some jurisdictions from a tax point of view. Now, what the OECD are looking at there is in relation to those types of payments and those types of income streams, do you get a deduction for the payer? Does the payee not recognise the income for tax purposes? And that happens quite a lot. Not the fact that you're not recognising it for income for tax purposes because you're exempt, but you may be able to use credits. So the OECD's recommendation there is that you would get one, no dividend exemption whatsoever for deductible payments and proportional limitation of withholding tax credits. But what this also means is that cross-border, you'd have to look at your economics on a stock loan transaction and work out, well, who's going to tax it under these proposed arrangements. So the threat here is that with stock loan and repo transactions falling within the definition of a hybrid financial instrument and a transfer, the paper talks about structured transactions, but it talks about payments under a hybrid mismatch, where there's a tax difference in one jurisdiction and not in the other, as opposed to the other. So without some specific guidance from the OECD or confirmation from the OECD that your normal commercial, everyday stock loan and repo transactions are going to be taken out of the structured transaction definition, then it sort of leaves it open at the minute as where do we stand as an industry. So in May, ISLA wrote to the OECD during the consultation process and submitted a letter sort of stating that normal commercial arm's length run-of-the-mill transactions that are undertaken on a daily basis for liquidity purposes should just be left alone and not encumbered by the proposed BEPS initiative. I think that one of the aspects that they're looking at, really, or a number of aspects, are sort of repo, tax credit double dips, and share lending transactions. They want to take a bottom-up approach, which I think is the preferable approach. It's a top-down approach. Bottom-up seems better. That bottom-up approach seems to deal with most concerns about tax policy, captures related party transactions, structured arrangements where they're designed to produce a mismatch, and it's more targeted. Now, related party intercompany transactions are affected here. At State Street, we borrow and lend intercompany ourselves for liquidity purposes. Those transactions are still in scope, and the OECD have mentioned that they are slightly concerned about a hybrid mismatch being of benefit to one of the parties where you're sourcing liquidity internally on an intergroup or intercompany basis. So EU FTT is bumbling along. Base erosion profit shifting for hybrid mismatch has to be finished by the 18th of September this year with the recommendations in place by the OECD. So BEPS has got a far more immediate impact, possibly, unless we get some common sense from the OECD and they decide that we could take our standard transactions out of the scope of the arrangement. But EU FTT remains a threat, I believe. Thank you for your time.
Thanks, John. And now you know why we wanted to bury the tax piece in the middle of all of this, just to not alarm you too much. But it was only in April this year that I started to hear for the first time about BEPS and what it meant. And it's a good example, I think, of where our tax group have been issue spotting and finding things that we need to care about. And if anybody really wants to know more about BEPS, because it's a very complex area, as is the FTT, then please get involved or get your tax specialist involved in our tax working group with John. We just want to run through, we've highlighted some of the key issues, but that, clearly that's not all that's on our list at the moment, and we just wanted to highlight a few other things that we're working on and that you should be aware of. I mentioned earlier that the Financial Stability Board had been reviewing securities financing transactions and had established some principles late last year. The work of the FSB shadow banking review is still ongoing, and there are two particular pieces of work that are being completed, hopefully this year we expect. One is they're in the process through a group called the Data Experts Group of establishing some global standards for the collection of securities financing transaction data around the world. And this is really something that's aimed at regulators around the world, where the FSB are saying, we've told you that we should all be collecting more data on securities financing transactions, and now we're going to tell you at the centre, at the global level, what we need to get from you as you go collect it. So that's quite interesting, and Andy was in New York last week participating in a working group meeting with the Data Experts Group. The other area that's still outstanding with the Financial Stability Board is the whole area of regulation of haircuts. And this was quite a controversial subject at our conference last year. The FSB said, or certainly the Shadow Banking Workstream 5, which was looking at this, said that they felt that this industry should have regulations covering haircuts, potentially requiring minimum haircuts to be set for securities financing transactions. And the policy objective here is to dampen down pro-cyclicality and to essentially put a floor on the haircuts that are applied to securities financing transactions, essentially making them, essentially stopping them from becoming too cheap, I guess, is one way to look at it. I have to say that it's all gone very quiet on this front, and we hear unofficially that this is proving quite a tricky area for the FSB to agree on how to go forward with. However, they are up against a bit of a deadline. The G20 meeting in November in Australia is due to receive a report from the FSB on this. And so we know that they're under some pressure to do something. We're just not quite sure what that will be at this stage. So 2 pieces of outstanding work, and obviously if we hear anything, we will let you know. Netting opinions, Andy's mentioned that already, but it's a significant effort on the part of ISLA to ensure that there are netting opinions for many jurisdictions around the world, covering the securities lending agreements that we publish, the GMSLA style agreement, to ensure that you understand where they're effective, and they're effective in most jurisdictions, but where they may not be. And that's an annual exercise, and it's, those opinions are available to firms on a subscription basis. UCITS regulation, we don't have a special slot on UCITS regulation, but there's a lot of ongoing activity with UCITS, which I think is quite relevant to anybody who manages UCITS funds or acts as an agent lender for a UCITS funds, or even borrows from UCITS funds. And you may recall earlier from Andy's pie chart about who the lenders are. Mutual funds globally are one of the largest sources of lendable securities, so they're quite important. And we see a gradual kind of creeping change to the regulations that govern UCITS regulations. We saw just over a year ago, ESMA published some guidelines which were designed to harmonise how UCITS regulations operate across, or rather the UCITS directive operates across Europe. And they impose some additional requirements on UCITS funds that do securities lending. More recently, we've seen some text in the UCITS 5 directive, which is due to go live very soon, which also affects how UCITS funds can take collateral, the forms that they can take collateral in. And we're expecting to see another review of securities financing type transaction arrangements for UCITS funds when UCITS 6 occurs, probably sometime next year. So UCITS is just an ongoing set of new rules that we're keeping an eye on. The next one on the list is the CSDR, the Central Securities Depository Regulation. This is a regulation many of you will be familiar with, but for those of you that may not be, it's designed to harmonise settlement regimes across the EU. And the way I think about it, there's two principal activities here. One is to move everything to a T+2 settlement basis. That's both equities and bonds. It's a minimum of a T+2, by the way, not a standard T+2. And the second thing that is implementation of a minimum set of criteria or standards for settlement disciplines. And we've been looking at both of these things to try to understand really the impact on the securities finance and securities lending markets. And there is still some concern, I think, amongst market participants about how the settlement disciplines could affect the securities financing markets. These disciplines will include fines for late settlements and mandatory buy-ins a number of days after a settlement of a transaction was due to settle. So this is something that we're actively looking in right now and wanting to understand better how the market needs to react. And lastly, the last thing on the list I would mention is something that we're calling the market review publication. So as we talk to policymakers around Europe, what we hear all the time is that this is all very interesting. We think your market is an interesting one, but we can't find much in the way of information or statistics about what's really going on. As is the case with the European Repo Council, who publish a 6-monthly review of the European repo market, we've decided to do something similar for the securities lending market. And we expect in the course of Q3 to publish some analysis of the size of the market globally as well as in Europe, and some interesting, hopefully, facts and figures about how that market is broken down. And we'll be working with the key data providers in the securities lending market to help pull that together. So we think that that's going to be helpful to our industry in describing what's going on, in helping policymakers to understand how things are developing, because I suspect that even with the development of a trade repository, which we're likely to see in Europe, it's going to be some time before policymakers are in a position to really see officially what's going on in this particular market. So I think they're the key things that are going on for us right now. Hand back to Andy to wrap up.
Okay, yeah, thank you, Kevin. The final thing I was going to mention is our operations conference. So it seems a bit bizarre to be talking about our next conference when this one has just begun. But some of you have been aware that for some time we at ISLA have been running a one-day operations-focused conference in London. What we're doing this year is we're doing it again. It's going to be on the 25th of September. We've been working quite extensively to revamp and re-energise some of these operations groups, because we believe they're fundamentally important to creating best practice methodologies, and also ironing out and dealing with what at times quite problematic issues around the way the market can trade at times. Those issues, I think, anecdotally are going up, not down, and therefore it probably makes sense to reinvigorate these particular groups. The focus of the operations conference in September, the details of the agenda are going to be published very shortly. We've already got co-chairs. We've got Patrick McManus and Russell Bellows from Nomura and Northern Trust respectively. And I think, again, this year, Nomura very kindly agreed to host the event. If you or any of your colleagues haven't necessarily participated before, please come and seek one of us out over the next few days if you'd like any further information. One of the things that we're also doing is creating a much stronger link between our operations world and, if you like, our front office world that's represented here today. So you'll see more from that forum feeding up into the sort of discussions we have both here and during our various working groups as the year sort of rolls on. So that was the only thing I wanted to say by way of conclusion. I think it's probably now, unless anyone's got any specific questions on anything that we've covered. Any questions? Probably not. No? Okay. I'm probably going to hand you back now to Ed, is it you? Or Mark, to take you through the rest of the session. And thanks so much for your time, gentlemen, on my right.
Thank you.